You know how you always see those headlines about companies posting record profits? Well, what if I told you that a company could be making a ton of money and still be destroying its investors' wealth? In this explainer, we're going to dig into a really powerful metric that cuts right through the noise to answer one crucial question. Is a company actually creating value for its owners?
It just sounds wrong, doesn't it? I mean, how can a company reporting billions in profit still be failing its shareholders? Well, believe it or not, the answer is a big yes. And the reason why is all about what those traditional profit numbers are leaving out, a really important piece of the puzzle that we're about to uncover. Okay, so how do we actually get the real story here? Well, there's a metric that was designed for this exact purpose. It's called shareholder value added, or SVA for short. And trust me, it gives us a much more honest look at how a company is really doing. So here's the official definition. Shareholder value added is what you get after you take a company's operating profit and then subtract the true cost of the money it took to generate that profit. We're going to break both of those parts down, but that's the core idea right there. What did we make minus what it cost to make it? Now, don't let the name shareholder value added intimidate you. SVA isn't some super complex financial formula, not at all. It's actually a pretty simple calculation that tells a really powerful story. So let's deconstruct it. At its heart, SVA is basically a balancing act. It's super simple. On one side, you've got what the company earns. That's its net operating profit after tax. And on the other side, you've got what it costs to earn that money, the cost of capital. The whole game is about figuring out which side is heavier. And the math? It's literally just two steps. First, you figure out the profit from the company's main business operations. Then, and this is the absolute key, you subtract the cost of all the money, both debt and equity, that the company had to use. That final number, that tells you everything you need to know. And here's where it all comes together. That final number gives you a crystal clear verdict. If it's a positive number, that means the company generated more value than it used up. Value was created. Simple as that. But if that number is negative, it means the company's earnings weren't even enough to cover its cost of capital. It actually destroyed shareholder value, no matter what its reported profit was. So you can see this isn't just some, academic exercise. SVA is a genuinely powerful tool that real-world investors use to cut through the marketing hype and make much smarter decisions. It's all about seeing past that shiny headline profit number. And you know who really loves this metric? Value investors, the ones who are focused on the long-term health of a business. They use SVA to judge two absolutely critical things: a company's true profitability, and, just as important, how effective its management team really is at creating wealth. You can almost think of SVA as a kind of truth serum for a company's financial reports. It reveals the real profitability, it's a scorecard for how management is doing, and ultimately, it separates the companies that are genuinely building wealth from the ones that are just kind of running in place. All right, let's pull all of this together. We've defined SVA, we've broken down how to calculate it, and we've seen why it's so important. So let's wrap up with the single most important takeaway you should remember from all of this. If you remember just one thing, let it be this. SVA is so powerful because it forces us to look beyond just profit. It answers the most fundamental question of all. Did the returns we made outweigh the cost of making them? Is the company actually generating a return that's bigger than the cost of the capital it had to use? That is the ultimate test of value creation. So from now on, whenever you see a headline about a company's quarterly earnings, you'll have this new tool in your back pocket. You won't just see the big profit number anymore. You'll probably pause for a second and ask the real question, yeah, but are they truly adding value? And now you know exactly what that means.